Ooh, look at this high yield ETF, HYLD. Wow, the yield is so enticing. Oh, just think of the money that's going to come into my account while the stock market is dropping. Should I do it? With the market dropping, you're probably seeing more and more opportunities. And some of you are wondering, are high yield ETFs right for you? Maybe you're considering diversifying your stock portfolio. Maybe you're like thinking, hey, these look so attractive. The high yield, oh, it's so enticing. It gives you money in your pocket, in some cases, every single month. So in today's video, I want to talk about the pros and cons of high yield ETFs. And I also want to talk about the biggest dangers of high yield ETFs. And I want to talk about what I think is a superior alternative to high yield ETFs, but is it right for you? So make sure you stick to the very end because I'm going to go over this point. Now, before we jump into the pros and cons, I just want to talk about what is an ETF. An ETF stands for Exchange Traded Funds, which is a fancy term just to say, hey, it's a bunch of stocks that they bundle together and then you could just click a button and buy them and you get exposure to hundreds of stocks across many different sectors, or it could be concentrated in a few sectors. Now, you probably heard your mom and dad talk about mutual funds. Well, ETFs are a modern version of a mutual fund. It's just that you don't have the high expense management fees. They have lower fees that you pay every single year. So a good example of a high yield ETF is like HYLD, which has exposure to a bunch of sectors in Canada and it tracks the performance of those sectors. So you get like exposure to a lot of sectors just with a push of a button and you get some income holding it. So here's the pros and cons of high yield ETFs. Pros, well, we get exposure, diversification to many different stocks with a push of a button and many different sectors depending on the ETF that you choose. Number two, it is incredibly passive. You just push a button. You just pick your ETFs that you want exposure to or get a robo advisor. They'll recommend some ETFs for you based on your risk tolerance and then you just push a button and you go buy and then you could forget about it because someone else is managing that fund for you. Another one is the low management fees. A lot of high yield ETFs, I think, run less than 1% in management fees, if not lower. So this is super enticing if you are cost conscious. Another huge benefit is that buying high yield ETFs on a lot of brokerages like Questrade or Interactive Broker, or even your bank, usually they have very low trading commissions. If not, sometimes it could be free if you use like Wealthsimple, which of course you could check out my affiliate link below and support my channel. And you could open an account and you might get a free stock by doing it. So what are the cons? Okay, well, with any investment, there's always risk involved. Of course, you want the rewards way higher than the risk that you're taking in. And of course, the probability of success being pretty high. So when you invest in a high yield ETF, you're owning a basket of stocks, which could mean like, yeah, you're diversifying, but in reality, you may actually be super concentrated in a couple of sectors. For example, looking at this very popular high yield ETF in Canada, a lot of it is actually concentrated on the financial sector, which may be too much exposure for you. It's like, we're going to double digit exposure to one financial sector. Also, depending on the high yield ETF that you own, well, it could be a leverage product like HYLD. And well, that in itself comes with higher risks. Another con is that, well, the total returns are not that great, okay? When you're going to give control to someone else, you can't have everything like the best returns and all that. You're giving up control. So part of it is just accepting that you're not going to get the best returns. You might be even lucky just to get average returns with a high yield ETF. Another one is you have to accept what's in the high yield ETF because you're giving up control. So whether they decide to rebalance the portfolio 10 times a day, well, unfortunately, they might do that for you and you have no say in it. And the selection criteria for what's included in each of those sectors, well, it's up to them, not up to you. So personally, when I look at a high yield ETF and I'll take a quick scan of what's in it, there's a lot of individual companies that I really don't want exposure to, like the commodities, because they're highly volatile, or bonds. Come on. Another big con is that you like having control. If you like actually knowing what you own, which I think you should if you're putting your hard-earned money into something, well, you're going to have to do some research no matter what. Whether you decide to buy high yield ETF or some other ETF, you still have to do, I would think you probably want to do some research of what that ETF entails, what type of companies are in it, how much exposure you have to each of those sectors, which kind of detracts really from owning ETFs because you actually should do some research. Now, I know a lot of people don't because they go with robo advisor, but if you're someone who likes control, who likes knowing what you own because you value your money, well, high yield ETFs might not be for you. Another one is volatility risk. Yes, I know. I talked about, yes, an ETF, a high yield ETF should actually be diversified, but you still get volatility depending on which sectors they're concentrated in. If you look at a high yield ETF like QYLD, you could see that actually the charts don't look so good in the last 5 or 6 years. Okay, it's on a downtrend, which isn't that great. Okay, so that in itself, if you don't like seeing your money dropping, your principal dropping, this may not be for you because essentially owning dozens of stocks doesn't actually decrease the volatility, okay, as you can see by these examples. So what are the biggest dangers of high yield to ETFs? There are two. The number one is when you sell. Have you ever looked at a chart for something like QYLD? Have you seen how much it's decreased by over the years? I don't know about you, but like, I don't care if a company or product gives you money every single year. If I see my principal dropping, it's just like, for me, I'm an emotional person. We are all human beings, and I don't like seeing my money dropping every single year. Number two is total returns. When you look at a product like QYLD, yeah, total returns might be looking like pretty decent over a 5-year period, even if when you sell, the principal has dropped. But overall, your total returns like pretty decent. I think actually QYLD is probably the best high yield ETF amongst all high yield ETFs because it tracks the tech companies. And of course, tech companies have done so well in the last 5 years. But just know that when you invest in a product like a high yield ETF like QYLD, you are giving up a ton of returns. If you compared this to owning just Apple stock or Microsoft, well, you could have got way better returns in comparison. I feel a superior alternative to high yield ETFs is actually dividend growth stocks. Dividend growth stocks are just individual companies, when we have a lot in Canada, that pay you money every single year. It is the boring companies. It is the telecommunications like TELUS. It is like the banks like TD Bank or the utilities like Fortis that are basically essential needs. And it's like, hey, when you go in Monopoly and you go buy the railroad tracks or you go buy a power company, it pays you money every time you land on it. Well, if you own these dividend growth stocks, they pay you money and they grow their dividends every single year, as long as you choose high quality dividend growth stocks. And by the way, if you want to even learn about how to invest in dividend growth stocks, big 101 guide, I have an ultimate guide to dividend growth stocks for a lifetime of passive income. I'll share it in the links below in the comments. So the great news about dividend growth stocks, well, you get to own some essential needs that will pay you money every single year. You get to have more control. Like if you're going to use your phone every single day and you're like, I'm paying for internet, you might want to think, oh, maybe you should be owning whatever that internet service provider is. It's not that hard. And you're more likely to have confidence in that company and you like knowing what you own. And in Canada, we have so many incentives to have dividend growth stocks. I mean, we have such huge tax incentives, like the dividend tax credit, which basically gives you $50,000 of tax-free dividends every single year, as long the only caveat is you can't have another job. But if you're in retirement, just imagine collecting $50,000 worth of dividends every single year and it's tax-free. Well, we have that credit in Canada. And it doesn't have to be in your TFSA or your RSP. It's outside your registered accounts. And if you're going to do some research, like investigate what type of ETFs you own, like high yield ETFs, like QYLD, HYLD, what type of holdings, what type of sectors exposure to it, because you like knowing where your money is going. Why not just do that with dividend growth stocks? It's not that hard. The research is out there. And my favorite thing about dividend growth stocks is that the longer you own it, and as long as you reinvest those dividends back into the company through a DRIP, okay, dividend reinvestment program, which is essentially going to buy more shares of the company, and it's commission free. You just got to set it up with your bank or your brokerage. And when you do that, over time, your income grows without you working any harder. You don't have to spend any more energy. It literally grows every single year. It's like Warren Buffett, who owns his Coca-Cola stocks. They initially didn't pay a ton of dividends, but because it is a dividend grower, meaning it grows the income that pays out to you every single year by owning these Coca-Cola stocks, and he's been reinvesting the Coca-Cola dividends every single year. Well, let's just say he's made a ton of money off his Coca-Cola stock, and he collects a ton of income every single year, the longer he holds it. But is it right for you? Yield or dividend growth? Which one is the right one for you? I think, in my humble opinion, if you are near retiring, or you're in the retirement stage, or you're just like an income investor, you're like income focused, you want cash flow every single year, the high yield is probably going to be super enticing, and you're probably going to accept that your total returns aren't that great because you want income every single year right now. Because the advantage of these yields, well, it just gives you income like right now. But just remember, the high yielding stocks may not always be the healthiest companies, okay? Because it's like literally hundreds of stocks, and some of those stocks probably have high debt and high payout ratios. Meanwhile, if you're a younger investor, like in your 20s, 30s, 40s, and you're not planning to retire until, well, decades later, or you have 10 years at least, or 15 years at least before you plan to actually use that income, then dividend growth stocks might be the better option for you, because over time, again, your income grows and surpasses what your initial cost basis was, like your principal amount that you invested in those stocks. Sure, the initial money that you collect isn't substantial, but guess what? If you pick the right high quality dividend growth companies, which we have a lot in Canada, and they grow their dividends every single year, you could literally grow and double your dividends in 10 years and get a decent total return. So if you have time in your hands, dividend growth stocks might be the better option for you. And especially if you like knowing what you own. Again, if you want to learn more about dividend growth stocks, I have an ultimate guide to dividend growth stocks. Check out in the links below.